Welcome back to another Market Insights. It is May. I haven't been back for a month. Joined as always by Aaron. Must have been a good month if we didn't have to do any other emergency shoots.
No, it was. My calendar felt a lot better the last couple of weeks for sure. But back on April 4th, you talked about peak uncertainty. Are you ready to take a victory lap yet?
I don't think we ever take a victory lap on these things, but it is certainly peak uncertainty. It looks like we're moving past it. It looks like the administration, what a great sign to turn things over to Besant, and it seems like Trump is getting out of the way.
It's the month of April, and it's a rare thing. We actually have a
not
surplus.
The month of April.
It's a month of May, and we just got the reading for April, which is obviously the big surplus month for taxes. And it actually was a surplus. That happens rarely. I think the last time was sometime in 2022, 2021. So because it's rare, make sure you hit that subscribe button so that you never miss out whenever we have great news like that coming at you. And while you're down there, make sure you hit that like button and send that to your friends if you want them to hear about the great news as well.
So let's just start by revisiting some of our old slides that we had so we can see where we've come and changed through this. So this is the peak uncertainty slide with the red that's been thrown in of what's new. What does a trade deal look like? You're not allowed to say hope in this industry. I held out hope that maybe we'd start throwing up some zeros and have some real trade deals, but it looks like they like tariffs, right? They're going to hold some tariffs on, that 10%, which has been your base case the whole time.
Yes.
Is that you thought they would arrive at 10.
Yes, but I also thought that they were really trying to isolate China, and it looks like we're getting. We haven't seen the deal yet, but they're going to the table, and it looks like there's some good negotiation coming out of that.
But those are the two pieces of news, right? The UK deal, which we're not going to spend a bunch of time on it. There's not a whole lot there. No one really expected much. It's just a good sign that we're moving past it. And they had some carve-outs, and they had the 10% minimum and said that's unlikely to happen for other countries, but 10 would really be the floor. So it'd be nice to see more people come in at 10. That's something we'll have to see. And last month, we weren't sure if China would start negotiating in Q2. And really depends what your priors were with the view. A bunch of people out there saying China was really struggling. They needed to negotiate now. But if you hadn't said that, typically you're saying, no, the U.S. was really struggling. We needed to negotiate now, too. But that's starting to move along. And Trump put Besant in charge of that, which was, again, a good sign. Another good sign just coming through, I keep coming back to it. I know it's a little bit silly. Lutnick, and go back to last November, where he said, we're just not going to tariff things we don't make. And then went ahead with supporting tariffing things that we don't make, significantly changing his view, and coming back again a couple weeks ago, talking specifically about mangoes. Again, stupid thing to reference, but saying...
At least it's not penguins.
Yeah. At least he's saying, in the mango deal, right now we are tariffing them, but once we get a trade deal, he, again, doesn't want to tariff them, because we can't grow our own mangoes, as we all know. And just saying that is just the path of saying, if we go down that path, market's going to be fine, economy's going to be fine. Do we start throwing up massive tariffs on things that we can't make? That's where peak uncertainty might not be behind us, but I think we're moving in the right direction.
I think we're past that part of the negotiation, if that's what you call this process.
Also calling them trade deals, right? They're blueprints, they're a term sheet, whatever you want to call them. We know they're not firm deals ready to go now. That doesn't happen doesn't happen even in 90 days, which is where we are with China. Right? We've really just kicked the can down the road 90 days and said, hey, we'll negotiate. We'll reduce tariffs somewhere around 30%. And they reduced their tariffs on us to somewhere around 10%. Pretty good for them. But it depends what view you take. If you're the administration and you like tariffs, 30% is considered low. Right before the negotiation last weekend started, Trump said, I'd like to see it at 80, but it's up to Besant. And throwing Besant in this, where he's a free trade guy who has to pretend he likes tariffs for the job, it's just kind of fun to watch. All right, another item. What do companies do this quarter? I think it's worth spending some time there. Do they just throw out the quarter? It also introduced kind of a fun thing for management. You have two options. You're watching your stock get killed if you pull your quarter, you pull your guidance.
Right.
Or you say, let's run it, we'll keep our guidance. And if we struggle through the quarter, we can kick the can down the road then and have a sell for missing our numbers. But we were surprised. A lot of people kept their numbers.
Yeah. I think Wall Street was expecting that they were going to pull guidance, and they didn't. For probably the game theory that you're talking about, well, why do that? Well, if we pull the guidance, we get crushed on our stock price. So let's just not pull it. And if we miss guidance, well, there's an obvious excuse that we have.
Yeah. And why don't you just spend a minute on some earnings, because this is what really is going to matter in the long run, is how do those companies do? And we can look at it. We already were able to preview the financial earnings because they report really quickly last month, and we liked them. Strong growth, above expectations. All the financials in our portfolio were doing really well. It's really the big tech numbers that came out recently that helped markets. And overall, the S&P 500 circle, they're squared off in green. The 13.4% growth rate, when at the beginning of earnings season in March, was only expected to be around 7. So strong earnings beats above expectations, and just pulling off a few of the big names that you'd expect. Apple, obviously, they struggled. Not a lot was expected out of Apple. They have so much Chinese business and supply chains there. Microsoft and Meta, great quarters. Responded really well. They had good reacceleration of the growth metrics that people really care about. A lot of people with Microsoft were surprised at the big move, but if you follow them closely, they have their cloud number. If they miss that by even a small margin, the stock gets killed. So seeing them to get reacceleration of growth and have a good number, it's not a surprise that was supportive of prices. And the other two big tech names, Amazon and Alphabet, kind of boring quarters. Really nothing really to see there, and all that together, but it's pretty supportive for earnings.
Yeah, it seems that we're moving back to what has been a decades-long trend of technology really leading us. I know in the investment committee we've been concerned and got closer to the benchmark because it didn't seem like that narrative was going to continue to go. But once again, here they are leading the S&P 500 up, and with profit, with earnings growth of 13%. I mean, that's the milk that drives stock price.
Maybe the most interesting one for me was Disney. Came out. One part of it's not interesting, and you've been saying it for years. You've always liked affordable luxury as an idea theme to put in a portfolio, and streaming is clearly showing that. If your times are tough, are you going to cut your streaming? Or maybe if things get really tough, but if you really want and you're using it, you're going to keep your streaming. And Disney put up really good streaming numbers, but the surprising part was that the parks number was really good too, especially with travel being down, and they guided to a pretty good parks number. That really supported the stock too.
We'll thank Brian McGeehan and family for that one.
Yeah, he seems like he's there every quarter. I want to go back. Let's go back to really the tax cuts, deregulation, M&A, because the deregulation M&A, it's not the focus now. It will be. You think that's something that we'll probably see Q3, Q4. If that gets pulled up again, that's another reason that could be supportive of markets. New thing the last few days is the tax bill is moving forward. I looked at it. Pretty much everything we've been saying, not a whole lot that's new. One thing that was new I wanted to hear you talk about was the MAGA accounts. It is, I wrote it down because I don't want to be calling them MAGA accounts. Money account for growth and advancement. It's the idea that babies get $1,000 in tax-funded accounts to spend again when you're 18.
Well, I would always say compared to what, there's plenty of money that we spend in the government that I think does even more harm. So no, I don't think it's a great idea to put cash into a young child's account to give them at age 18 after all that compounding. But it would help the stock market move up because you have more buyers. It is not the worst thing to do to make an investment in our next generation and giving them cash, but I feel like we're giving a Ferrari keys to an 18-year-old if they then can access that compounding growth at 18. And as always, money eventually finds a way to get to the people that treat it well, and I don't think most 18-year-olds will treat it well. But there are worse things to spend money on, too.
It just comes back to the stockholders eventually, right?
Yes, it does.
Yeah.
It does.
So far, all we've had, tariffs or tax, is a large increase in tax with no tax cut.
Whenever I saw the what is the big bill or whatever they were calling it.
It's beautiful.
It's beautiful. It absolutely is. It's not a tax cut, at least not for me. Whenever I run those numbers, my tax bill goes up. And it's the cynic in me. Every time I hear tax cut, revenue neutral, I know that they're just shifting who the target is. I don't think it's the end of the world. It's a shift of who is going to have the burden, and if I have to choose between the wealthy and the middle class and below, the wealthy will figure it out. So it's not a big deal, I think, for the overall economy. I'll just figure out how to increase a defined benefit plan or something here at the company.
And we'll spend more time on that once we get Senate notes and see what's more realistic to pass. Spend a minute on the MAGA account. Is that realistic to pass? There's been a Ted Cruz's idea for a long time. I don't know if he can get his guys in the Senate to want to support that. I don't know. It's nothing I've been following.
No one does big government like Republicans, right?
That's the summary of what you were describing, why you don't like it. Just another government program. I like things that juice the market. So let's go in on the reasons. Again, same slide, just changed up a little bit from last month of bottoming signs that the market is put in that bottom versus further to fall. On the bottoming side, we got trade deals, green. We're starting to see what they look like, and eventually they'll become a sell the news. And a lot of people are saying these were going to be initially sell the news, but it's the pessimism out there. They didn't think we'd get this done that quickly. We really targeted the end of this week where the market was going to get anxious. If we weren't getting deals by the 16th of May, the market was going to struggle. So they got a few of those moving forward. It's a good sign. We already talked about tax cuts, deregulation, things we need for a prolonged rally. The Fed wants to cut. Did you listen to the Fed?
Do they want to cut?
Did you listen to the Fed meeting last week?
I didn't listen to the Fed meeting last week.
That's my point. I didn't think you would, because you didn't have to. It was
No.
the most boring meeting we've ever had. Right? It's nothing. They can't do anything right now. They need to wait to see what happens to these tariffs.
And do they even need a cut? With the surplus that came in, it's so weird to even say surplus for the U.S. government. And it only happens in April. So I'm not saying that it's going to be an ongoing component, but rates went down because of that. Because the government is going to need less bonds because it had a surplus. So then rates were reflected in that. And then we've seen the inflation number also. It's been looking quite well.
Great.
So far, I'll take the victory lap. I guess the tariffs really haven't been fully experienced to see if it shows up in the consumer price index, but it continues to trail down.
I mean the Fed wants to cut this year. I don't mean they want to cut at their next meeting or even before their summer in Jackson Hole. I just mean they feel confident that rates are restrictive in the low 4s, and they want to get them to the low 3s and mid 3s over the next 18 months. Yeah. And that's reasonable. That will become supportive of markets. You already mentioned disinflation trends. Got a great inflation number. That's got to be green there. AI will eventually help that too. Further reasons to fall? Well, we said last time technical traders were sidelined. When you look at the chart, we won't spend a bunch of time on it. They like what they see from a chart perspective. So they're actually re-entering the market.
I don't know that we'll use the slide here, but you sent that meme where it had the retail investors trying to buy at, 4,800 on the S&P, and then the institutional coming in now trying to buy. I think a lot of that is a technical component. You can't be left at this point. All of the pessimism that was feared isn't showing up, and the market is moving. I think a lot of the institutions are realizing the market's going to move away from them.
Support, exactly, that they missed it. This rally, the joke of the rally was year to date, markets are basically flat, and most of the rally happened in less than an hour of trading. Really 3 big days in the market. If you were just in it for those 60 seconds or 60 minutes, you got all of the rally throughout the year.
One of the other things that you talked about, and I'm sorry to jump around, is just like what it looks like after a correction, especially if there isn't a recession 12 months from now. And on average, it's up 31%. That's phenomenal.
This is the chart of what happens if it's just a deep correction. Correction is usually 10%, and bear market is 20%, is what people like to use. I like slightly different metrics. But for this example, if you're seeing that 15 to 20% and you don't go down more than that, that's saying if there's a recession, you always go down more than that.
That's what makes it into a bear market from a correction.
So this is just saying, in those good scenarios, because you avoided recession, do you snap back quickly? And in all of the scenarios that we have here since the 50s, you snap back pretty quickly.
And this is one of the big reasons why you don't want to move out of the market during these times, is because the likeliness of a recession, let's say it's 50-50, well, you're going to miss out on the 31% upswing, and you sold out whenever you had already corrected by almost 20%.
And our strategy was to defend with our fixed income. So yes, our equity strategies recovered fantastic. We caught all the upside in these strategies above our benchmarks on the upside part. That's what we wanted to do. That was the goal. We didn't on the fixed income. Bonds sold off, which is to be expected. Equities are rallying. People are selling bonds to buy equities. Our bonds struggled a little bit relative to our benchmark, but that was the goal. That was what we were trying to do, because they would have hedged us on the other scenario.
Right. And we're starting to see trends, but one of the things that we also have is just a feel on all of our clients. What are you hearing from them, and what's your take on that? Because that's one of the considerations we use just to understand the mood of the market.
Right. And you said it, that the institutions line up to buy now, but they didn't when the market was selling off. One of the signs that we were seeing is the exact opposite of that. Our clients were sending us a lot of money. And we've put over $5 million in cash to work throughout the large dip of clients just saying, I don't know where the market's going to be next month or next few quarters, but a few years from now or in a year, it's probably going to be higher. And that's the data supported that. It wasn't just us. All retail across the board was doing that. I pulled the Bank of America note here showing that retail's been buying consistently the last 20 weeks, and significantly there are other reports showing actual dollars of the buying. And retail tends to get bad headlines because people think of retail as the Robin Hood trader buying Palantir or Tesla. No, it is that, but it's also business executives, the best small business owners that are our clients, saying, I have a bunch of cash, let's get it to work long term.
Another thing on the business executives, we've seen a lot of stock buybacks. That's also very constructive on where we are, that the stock, or the companies and the people that know those companies well consider the current price to be a bargain, and they've actually bought shares. So all positive notions, and one of the reasons that we have been, I guess, cautious but also constructive on the market through this correction.
That's another thing that's just going to be supportive through choppy markets, because businesses keep buying back their stocks. And then just to close out, the further reason to fall, we had called it, what happens, bad trade policy. We had put in actually last month something on Apple and Nvidia where they're in the headlines for some of their products not being able to be sold or not having carve-outs. And we don't know where these Chinese deals are going to end. But the markets, generally people are throwing out that between 40 and 60% tariffs is where we start to line up when the deal is actually done. Well, are we on the low end of that? Does Trump hit his 80 number that he was probably joking about before negotiations? That's what I mean by there could be reasons to fall if we start pulling back from good deals and start seeing things that really don't make sense. Because that will lead into the economic damage. There will be damage from bad policy. But as long as we're on the path towards what your base case was, that 10% plus China and somewhere in between with some carve-outs, which could get you to 10%, we'll be fine.
And we've been operating, or at least I've been operating on, they had to get this done early so they can start to gear up and get a strong market as they're going into midterms. And at this point, sell I think would be quickly reversed by the administration, because they're realizing it's now, they're starting to get some good news. They got to start beginning that campaign for the midterm elections. So now you have tax cuts, you have deregulation, you have the surplus. There's a lot of momentum behind them. I can't imagine them coming back and trying to sabotage the good results that they've been able to get out of this market. So they took their lumps early, and they're set up, and I believe this has all been political. And that they would get away with those things, because a lot of the seen things where people are investing money back in the U.S., you see things. There's all the things that are happening that could have improved the quality of life that are never seen or never done, but you can point to those, and politicians love to be able to point to those results, and they're getting them.
And just to summarize the positioning game, we didn't call attention, throw the slide back up here, which is the institutions, who are the ones panicking and selling significantly. The right hand, there's a bunch of ways to measure this, is just showing their long-short ratio, showing that they've reduced their longs significantly and actually added shorts, recently having to take those shorts off, which is a forced buyer to the upside. And could it be a new normal down here with their ratio? It could. But generally, if we're going to see the economy stay strong, they're going to come back as buyers and probably return back to where they were. And exactly like you said, line up to buy at where the market is.
And that's the meme is funny at 5,700, but the short covering is what would push them to have to do that, because every time the market goes up, their fund goes down even more.
Right.
So they have to aggressively buy, but then that becomes a cycle against them where the price continues to go up. So that's one of the things I love about a short selling is that creates a natural buyer to finally find a bottom.
Mm-hmm. And another thing they could be looking at is labor market. We look at the initial claims each week, and people have been saying, well, that's going to be a great signal. It's a forward-looking indicator of where the labor market's going, and it's been really well behaved in that 220, 230,000 per week, a great signal that the labor market's not deteriorating. Jobs are being added. That's the chart we have here, top left, change in payrolls. Well, they're still increasing. So we're not in that recession, which a lot of people said we were. Unemployment rate is stabilizing but rising a little bit, and that could increase. We have the participation rate increasing. That's the bottom left. More people come into the labor force. If they're not filling those roles, you're going to see an increase in unemployment. But so far, the labor market looks okay. I wouldn't say strong. I'd say okay.
I know we're getting close to our time, but one thing that we didn't talk about that caught the headlines was the negative GDP. Over the previous quarter. And when you look at it, and I'm not saying that it's like this is a bullish thing. I know that some people came out that were pro-Trump that have made that case. But I just think it's the oddity of how GDP is calculated because you subtract imports. And there's good reason to. It's not that you just deduct imports. It's that they're built into the things that you sold. So you're backing that out to remove the imports. But if there is front running, and trying to bring more imports, they're not necessarily getting put into the inventory that is being sold. So that is in that one quarter detracting from GDP. I saw a lot of investment as well. So I wouldn't take too much of that as a bad sign. Obviously, if there's another quarter where it's flat to negative, that's going to be an issue. But I do think that we just have the imports that were being brought in early detracting on the way that it calculates. Now those things will be put into the products that they're selling, so GDP will be higher in the way that it's calculated in the forward quarters as they spin down that inventory.
That's a good point, that it's going to be a headline risk. As you know, we still want to follow there's the macro of what's happening there, and then there's the micro of the businesses, and the businesses are saying we're okay. And there are reports like that that'll come out that can be really confusing. The market went down 2% on that number, because they thought, oh, it's a bad number. Took some time, recovered actually positive that day, showing that they were able to look through it for the reasons you just gave, and that it wasn't necessarily a bad number. But that's a risk going forward, certainly, of what could happen. Let's just close with inflation, because you referenced it, but just to show the progress. Right here we have the 3 different measures of inflation we track and the Fed funds rate. The one we quoted earlier is that dark, maybe it's a black line, 2.3. It was 2.4. It's actually hitting the headline CPI number that came out this morning. It's the lowest it's been in 4 years. It's a great sign of disinflation trends coming. You also said that they're not necessarily showing any tariffs in there. A lot of people think that you could see a significant spike from the tariffs, so a 1% spike in this. I think that's overstated. And so I think, but again, it's another headline risk that we get as those numbers continue to come out over the next quarter.
Well, ultimately, inflation is a monetary phenomena. The way that the tariffs will go up while you're running higher government surplus. So if you went back to that GDP, there was actually less government spending. It's minimal, but it is spending less. And if the Fed is keeping the rates where they are, that means that we're not accelerating the supply of money. And if we're not accelerating the supply of money, these things just offset each other, and the CPI will continue to trend down until the government begins to spend, MAGA accounts, or the Fed cuts interest rates, or both. That's when we'll finally see that inflation number ticking up. Chris, one final question for you. If you had to draft one tailwind for the second half, what would it be? Would it be rate cuts, which we talked about, tax reform, trade clarity? Which one are you betting on?
Wow. It's a great question. I would break it down and say the market absolutely needs 2 of those. They need the clarity on trade deals, and they need the clarity on the taxes, because we've had this large tax increase that we've talked about from tariffs. The market doesn't need the rate cuts. So if I would take the other 2, I'd say, yes, we need those. The markets, it looks like they're going to deliver on those, right? And it's the rate cuts that would just be on top of that, which would be nice and supportive. If inflation continues to trend down, you already referenced it. If that continues to happen, we'll get 2 to 4 rate cuts throughout the year. but the market does not need that. You take yesterday, for example, where we had strong moves in equities. Rate cuts are getting priced out. People are saying we don't need rate cuts anymore when equities are performing this well. So as long as that's happening, you don't need that. I think we absolutely need the other two.
I think I'm rubbing off on you. You want higher rates, interest rates? A hard money guy now?
I hope that's not what I said, because it wasn't what I was trying to say. But thanks a lot for joining us this month. We will be back next month, or if not sooner.